Well, joining me now virtually to discuss the trends and intricacies we've seen in the Treasury bills and bond market, I have with me Gafar Bashir, Senior Associate, Global Market, and he works with Parthian Partners. Thank you very much for joining us on the show today, Gafar.
Thank you so much.
Well, let's now start off with some school of thought around the government's preference of Eurobonds at high interest cost and with the associated exchange rate risk, which may likely hurt Nigeria sooner than anticipated. What's your take on statements like this?
I'm not sure I would agree with that, or at least as of today, as of 2022, that the Nigerian government has preference for Eurobond borrowings. If you asked me this question this time last year, or even 2020, I would have agreed with you, and for good reasons, anyways. So, what I'm trying to say is that since developed economies by the US and the EU embarked on quantitative easing programs where they flooded the market with cash in an attempt to combat the impact of COVID-19. We saw yields in the international market and Eurobonds market generally crashed basically or trended downwards, and which provided ample opportunity for emerging and frontier markets to emerging and frontier market governments to access funding at these low rates, right? And that's the reason why we had seen significant borrowings by a lot of African countries in starting from Q3, Q4 2020 down to Q3 2021, right? However, since the US Fed, the US Fed and other EU central banks, the ECB, they've commenced and announced, they announced and commenced the reversal of the quantitative easing programs where hawkish stance have been where they adopted a hawkish stance. We've started seeing a reversal in the trend of yields. Yields have been trending upward, and which has generally discouraged emerging market governments to tap into the Eurobond market and Nigeria. And we'll see the same for Nigeria as well. I mean, since year to date, we've only seen the DMO tap into the Eurobond market to the tune of 1.25 billion, and that's not significant. 1.25 billion, which amounts to about 525 trillion naira. And when you compare that with the approximately 2.6 trillion that was budgeted for foreign borrowings this year, you would agree with me that would not exactly qualify the current stance by the federal government as preference for Eurobond borrowing.
And now, despite the increase we've seen in the benchmark monetary policy rate by the Central Bank of Nigeria, we saw that in May, and then we've also seen this latest move this month as well, just a few days ago. Nigeria's Eurobonds for long-term instruments still hovered above 10%. Some market analysts had hoped that investors in Nigeria's fixed income market may benefit from the rate hike with adverse effects expected in the equities market. Do you think this is yet to be seen as well?
We expect the MPR hike to impact the fixed income market, but just the local market for the most part. And maybe it's understandable if you expect an adverse effect in the local equities market as well. But for the Eurobonds market, I would not expect the MPR rate hike to impact the Eurobond market, given that the monetary policy rate is a benchmark, a key policy rate for the local markets and for local investors. In comparison or in contrast to the Eurobond market as for international investors. However, even for local investors, following the announcement of the MPR hike, a 150 basis point hike, we saw a knee-jerk reaction of about 30 basis points on the long end of the Naira yield curves. So that's, I'm talking of 30 year paper. We saw yields trend upwards from 13% to about 13.3% levels, and for shorter dated papers, we saw maximum of about 60 basis points. It wasn't significant, and it was short-lived. As Following auctions by the DMO and the CBN suggested that the federal government and the central bank is not exactly prepared to incur higher borrowing costs than we currently have, right? And there are other factors that ensures that or that keeps that ensures that yields in the bonds market does not rise too much. One of which is the introduction of the secondary market charges by the SEC of 0.05% on secondary market transaction in the fixed income market. This generally discourages secondary market activity and kind of stems volatility. So what you have is that PFAs and other fixed income market players, big players, asset managers would rather go to the auction than trade in the secondary market. So going to the auction means there's significant demand, which keeps borrowing costs low for the federal government.
And let's also look at quite some interesting plots here. We also see the Debt Management Office releasing its federal government of Nigeria bond issuance calendar for the third quarter of this year. A plan which is aimed at raising between the range of 630 billion naira and 720 billion naira in the next 3 months. What do you make of this move?
The issuance calendar that was issued by the DMO for Q3 is essentially identical to the one that was adopted for the second quarter of 2022. However, we do not expect to have the same outcome, right? And in Q2 2022, we saw high level of subscription in at the auctions, right? At the bond auctions, for every the bid to cover at the auction was about 1.7 times as compared to 1.17 that was seen in Q1 2022. And going into Q3 2023, we would not expect to see as much demand as we've seen. Going into Q3 2022, we do not expect yields to go higher or significantly higher. Instead, we actually expect to see a reversal in yields, a downward trend in yields. And the reason for this is a couple of reasons. One is the fact that as at the end of H1 2021, the DMO has achieved, the federal government has achieved about 55% of its planned local borrowings. It set out to borrow about approximately 2.6 trillion in the local market, right, at the beginning of the year, and then a supplementary budget that brought its local borrowing targets to 3.6 trillion, right? And it has, out of that target, the DMO has achieved 1.95 trillion naira of that, which is about 55%. Now, that suggests that they've achieved a significant proportion of that. And we understand that if the federal government access borrowings from other means, most notably is the CBN ways and means to the federal government, which means they most likely wouldn't tap the entire local planned borrowing in the public market, right? So and like I mentioned before, factors like the PFA's aversion to participate in secondary markets and preference for primary market activity would ensure that production would have demand and would keep borrowing costs low for.
Okay, now let's try to place pundit here and I'll make some forecasts, especially within the Treasury bills and bond market as well. The CBN Treasury bills for the 1 year tenure were oversubscribed by a whopping 527% just last month. What twists and plots do you see coming to bear in the last 2 quarters of this year, as we also set our sights on the year 2023?
Well, one major factor that has determined how the fixed income markets, the activities in the fixed income market the past couple of years past few years is the CBN unorthodox policies, essentially, right? One of which is the borrowings to the federal government through ways and means. Now, so long as that continues, the CBN continues its unorthodox policies, which we expect to be the case. I mean, it's just a few months to the elections of this current administration, where this current administration is expected to leave government. There's less incentive for current trend or current pattern to change, right? So we still expect to see significant the CBN bailing out the federal government in by means of borrowing them funds by the ways and means window, right? And which, like I mentioned earlier, we would see a downward trend in yield. We expect to see a downward trend in yield in treasury bills and also the bond market in the second half of 2022. We have significant coupon payments that is expected to drive that. About 678 billion is expected in coupon payment in Q3 and 259 in Q4, right? So all of these factors is expected to ensure that yields continue to trend downwards. The only opportunity for twisting is if the CBN decides to, I don't know, change their stance from unorthodox policies to try to normalize activities within the monetary policy, in their monetary policy. Then that might just be the surprise that market participants could see in the coming months.
Okay, now, what's really now your word to investors as well, sitting on the fence, especially for speculators who are overwhelmed with pessimistic market sentiment, and which haven would you also be pitching to prospective audience who are yet to get into the market and waiting for a little bit of wooing?
Well, this, despite the current economic realities, right, and pessimism that might be contagious, or that might be that you might perceive as a result, right? There are still opportunities for investors to take advantage of. Um, I mean, for retail investors, one thing that's one the statement and principle that has stood the test of time is cash is king, and like we already know, this given the effect hawkish stance where policy rates are being hiked, the impact on the Nigerian Eurobond market means yields have been trending upward. So Eurobond papers might just be a good opportunity for retail investors in Nigeria to take advantage of, because one, it gives them access to higher yields than they will get. I mean, comparable papers in Eurobond for Eurobond as to local, for the same maturity local papers is has higher yields than local papers, right? And not just that, it also gives you a form of currency devaluation hedge, right? You will be able to hedge your currency risk. So not just the fact that you'll be earning good yields, you also be a hedge from devaluation risk that might occur within the span of the remaining months of the year. So yeah, I would recommend Europe retail investors in Nigeria to take advantage of the Eurobond market this period.
Thank you so much for your time on the show today, Gafar. It's been a pleasure speaking with you.
Thank you so much.